Hey, we need to talk about the Bitcoin 4-year cycle. For years, this was our playbook, right? The halving happens, the supply gets squeezed, and the price booms. Simple, predictable. But what if that entire rulebook is being rewritten right in front of us? Tom Lee, over at Fundstrat, a guy I respect a lot, he's been sounding the alarm on this, and we need to listen. He's arguing that institutional buyers, the big Wall Street money, are fundamentally breaking this old model. And let's be honest, the numbers don't lie. Think about it. It used to be a retail-driven market. Us, hype, FOMO, that's what fueled the rallies. But now, it's a completely different game. We're talking about the spot Bitcoin ETFs. Look at the flows. It's not a short-term wave. It's a steady, consistent drip of capital from institutions looking for a real store of value. BlackRock's iShares Bitcoin Trust pulled in $700 million in August alone, and that was a slow month. This isn't tourist money. This is long-term, sticky capital. And then you have the corporations. More and more companies, over 200 as of this summer, are putting Bitcoin directly on their balance sheets. We're not just talking about crypto-native firms. Semler Scientific, a medical company, Metaplanet, formerly a Japanese hotel chain. They are transforming their business models to become Bitcoin treasury companies. Why? Because they see the writing on the wall. They're hedging against inflation, and investors are rewarding them for it. So what does this all mean for the 4-year cycle? It means the demand side of the equation has permanently changed. We're no longer just relying on that post-halving supply shock to drive the price. We now have a constant, growing base layer of demand from institutions. They buy the dips. They accumulate systematically. They don't panic sell. Tom Lee believes this could lead to Bitcoin replacing gold and eventually hitting price targets that many thought were impossible. He's talking about the cycle drawing to a close. So, is the 4-year cycle completely dead? Maybe not dead, but it's evolving. Those violent peaks and troughs, they might start to smooth out. The bull runs could be longer, more sustained, instead of these parabolic blow-off tops we're used to. Those 70–80% crypto winter corrections, they might be a thing of the past, replaced by healthier 30–50% drawdowns. The market's DNA has changed. The dynamics have shifted. The old rules just don't apply anymore. The Bitcoin playbook is being rewritten by smart money, by Wall Street. And if you're still playing by the 2020 rules, you're going to get left behind. This is a new era. All right, so last time we talked about the 4-year cycle evolving. But now, Tom Lee is dropping an even bigger bombshell. He's saying it flat out. Stock market liquidity has ended Bitcoin's traditional 4-year cycle. Let that sink in for a second. This isn't a debate about the cycle getting weaker anymore. This is a declaration that the core engine has changed. And he's not alone. The entire industry seems to be echoing this sentiment now. Pierre Rochard, he pointed out a genius-level simple truth. There's only 5% of all Bitcoin left to be mined. Think about that. The halving used to cut a huge chunk of new supply, creating a genuine market shock. Now, the impact is significantly weaker. It's a ripple, not a tidal wave. So if it's not the halving supply shock, what's the new driver? Jason DeSalt knit it out perfectly. He said Bitcoin's price is now equally influenced by global liquidity, ETF flows, and the on-chain supply mechanics. In other words, Bitcoin has joined the main stage. It's reacting more and more to the same things that move stocks, bonds, and commodities. Interest rates, Fed policy, macro investor sentiment. All of that is now part of Bitcoin's story. And then you have the regulatory catalyst. Matt Haugen at Bitwise pointed to the Genius Act passing back in July. That wasn't just another bill. That was Wall Street getting the floodgates opened, allowing them to build a new wave of crypto-focused financial products. It's cementing Bitcoin's place in the traditional financial system. So where does this leave us? Tom Lee posed 2 critical challenges. Will Bitcoin follow a cyclical downturn next year, and will it decouple from the stock market? Based on everything we're seeing, a brutal, old-school crypto winter is less and less likely. The ETF inflows and corporate adoption are creating a demand floor that never existed before. But decoupling from stocks? That's the trillion-dollar question. For now, they're more correlated because they're drinking from the same well of liquidity. The old model is deteriorating. Matt Haugen believes we're entering a more prolonged, sustained growth phase. No more parabolic spikes and 80% collapses. Just maturity. So forget the old 4-year charts. The playbook has been thrown out. The question isn't, when's the next halving anymore? It's, what's the Fed gonna do next? Welcome to the big leagues. Hold on. We've been talking a lot about the 4-year cycle being dead. That Wall Street money, global liquidity, that it's completely rewritten the rules. It's a good story, a clean narrative. But what if it's not entirely right? Because there are some very smart people with very good data who are saying we need to pump the brakes. Let's talk about Glassnode. The on-chain analytics firm, they're looking at the data and saying, not so fast. They argue the traditional 4-year cycle still maintains its structural integrity. And here's why. They're tracking the profit-taking behavior of long-term holders, and it looks remarkably similar to previous cycles. But this is the kicker. In both the 2015-2018 and the 2018-2022 cycles, the all-time high happened about 2 to 3 months later than where we are right now in this one. Do you see what that means? Glassnode is suggesting the cycle isn't broken, it might just be right on schedule. And this idea has support. Connor Howe over at Enso makes a really nuanced point. He says the halving's impact is diminished, not eliminated. It still matters for mining economics and long-term scarcity. It's just that traders can't rely on a strict 4-year framework anymore. And you can feel this tension, this uncertainty in the market right now. The price dipped below $110,000 over the weekend before recovering back to around $112K. Investor confidence? It's fragile. Everyone's eyeing that last peak from last month, that $124,128, and wondering if we have the gas to get back there. In fact, a recent market poll showed almost 70% of people expect a dip to $105,000 before any potential move up. So, what's the real story? Is it Tom Lee's new paradigm, or is it Glassnode's history repeating itself? I think the truth is somewhere in the middle. The institutional money has raised the floor. A catastrophic 80% crypto winter is probably off the table. But the psychology of the market, the human behavioral patterns that Glassnode is tracking, maybe that's still intact. Maybe the cycle isn't dead. Maybe it just has a much, much better safety net. The next 2 to 3 months are going to be critical. They're going to tell us if the old ghost in the machine, that 4-year cycle, still has one last trick up its sleeve. Stay frosty. All right, let's step away from the price charts for a minute. Let's forget the 4-year cycle debate we've been having. Today, we're talking about something more fundamental. We're talking about the bedrock of the Bitcoin network, its shield. Because over the weekend, something incredibly important happened. On Sunday, September 7th, 2025, the Bitcoin mining difficulty was adjusted, and it soared to a new all-time high. We are talking a record 136.04 trillion. In simple terms, it has never been harder, never required more raw computational power to create a new block of Bitcoin. So why is this happening? It's a direct result of the hash rate, the total computing power on the network, going absolutely parabolic. The hash rate is now at 1.041 billion terahashes per second. That's a 48.20% increase from this time last year. And this is being driven by a few key things. First, it's conviction. Miners are pouring billions of dollars into the latest infrastructure and hardware. You do not make that kind of bet unless you believe the future price of Bitcoin is high enough to justify the cost. Second, it's a technological arms race. New, more efficient generations of ASIC miners are constantly coming online, pushing the total hash rate higher. And finally, it's fierce competition. This environment forces less efficient miners out, making way for larger, more optimized operations. So, what does this all mean? For the network, it means one thing above all else: security. a fortress. The higher the hash rate and difficulty, the more astronomically expensive it becomes to conduct a 51% attack. We're talking borderline impossible. This solidifies Bitcoin's position as the most secure financial network in the world. For the miners, it's a double-edged sword. This intense competition can erode profit margins, especially if the price isn't keeping pace. It's survival of the fittest. And for us, the investors, this is a profoundly long-term bullish signal. A healthy, secure network is the foundation for everything. Seeing miners invest this heavily shows their deep belief in the ecosystem's future. And historically, a rising hash rate has often preceded major price rallies. So while everyone is staring at the daily price fluctuations, the real story might be right here. This isn't just a number, it's a statement. It's the sound of the Bitcoin network building its most powerful defensive shield in history. A fortress of pure computational power, getting stronger every single day.
All right, we've talked about the network's rock-solid foundation. But now, let's get into what's happening on the battlefield. The price charts. Right now, Bitcoin is in a fight, trading around $112,000. We're trying to recover after bouncing from that $107,000 support zone. Let's look at the daily chart. The big picture shows us pushing up against a wall. The price is sitting just under the 100-day moving average, and it's turned into short-term resistance. You can feel the hesitation. The RSI is weak, sitting near 48. That suggests that buyers are present, but they lack strong conviction. So on the daily, it all comes down to one key level, the line in the sand, and that is $110,000. That's the key pivot area. If the bulls can hold that line, the next target is $116,000, and eventually we can start talking about that $124,000 high. But if we fail, if we break below $110K, we risk getting dragged back toward $104,000, where there's a larger pool of demand waiting. That's the big picture. Now, let's zoom in. On the 4-hour chart, the story is a little more optimistic for the bulls. We're seeing a double bottom pattern forming around $106,000. That's a classic reversal signal, and it's what triggered this bounce back toward the $112,000 neckline zone. The RSI here is stronger too, climbing toward 59, which reflects stronger short-term momentum as buyers try to regain control. So, what does this all mean? It means the battle is happening right now at $112,000. If the bulls can break above this level with volume, the next target is the $117,000 supply zone. However, if we get rejected here repeatedly, it weakens the structure and could push the price right back toward that $110,000 region, making it another battleground. And let's not forget the one concerning note mentioned in the analysis. On-chain activity reveals a slowdown in network usage. That could weigh on the sustainability of any bullish momentum. So, we have a tug of war. The daily chart is showing caution, while the 4-hour chart is showing a glimmer of hope. Watch the $112,000 level closely. It's going to tell us who's in charge.
All right, we've looked at the charts, we've identified the battle lines at $110,000 and $112,000, but the charts only tell part of the story. To really understand what's happening, we need to look under the hood. We need to look on-chain. And what the on-chain data is showing us right now, specifically the number of active addresses, is a bit concerning. Here's the deal. Even though the price has been relatively stable, the number of people actually using the network has been trending down for months, and it's showing no significant signs of a comeback. This is a classic divergence. Price is holding up, but network usage is falling. So the big question is, why is this happening? There are a few key theories. First, the growing dominance of institutions, The big money is increasingly treating Bitcoin as a tradable asset, like digital gold, not as a medium of exchange for everyday transactions. Second, it could be retail users rotating out. They might be chasing gains in altcoins, diving into DeFi, or just parking their cash in stablecoins. And third, it could actually be a sign of long-term conviction. The long-term holders, the hodlers, are moving their coins into cold storage. They're not selling, they're not trading, they're taking them off the grid, which reduces on-chain transaction activity. So, what's the bottom line here? What does this divergence between price and usage signal? It signals that liquidity is getting thinner. With fewer active users, the market is being dominated more by short-term speculative activity rather than real organic adoption and use. And that makes Bitcoin more vulnerable to sudden price swings. When demand doesn't come back, these thin liquidity conditions can lead to massive volatility. So when you're watching that battle at $112,000, keep this in the back of your mind. This weakness in on-chain activity, this thinning liquidity, is the shaky foundation that the current price is built on. It's a warning sign we can't ignore.